Hello, hello. Hi, everyone. Happy New Year. We are going to kick it off talking about Orange County real estate, what to know in 2022. So the topics we'll be covering today is obviously how to compete as a buyer in this really competitive market, how to get top dollar on your listings as a seller, how to utilize a 1031 exchange on investment property sales, what first-time buyers need to know, and what MR can do for you and should do for you, how to make offers stand out amongst the rest. So without further ado, I'm going to get started. We're going to obviously discuss a little bit more about Marshall Reddick and what we do for those that don't know, but we're pretty unique in our approach. We are a real estate broker, so we help clients buy and sell, whether that be a primary property or an investment property. But from that, we also do private lending. So we act as a private money lender. And it's pretty unique in that approach. So we get borrowers that come to us looking for either a fix and flip or rental properties, or even doing a cash out refi for investment properties as well. And our last division within our company is we're a property manager. So for those that are interested in renting out their properties, we could also manage the asset and take care of it on your guys' behalf. So for me, my name is Evan Balsis. I've assisted over 100 million plus in transactions within the last 5-6 years. I own multiple investment properties. I'm a certified real estate financial modeling consultant guy, and I carry my California real estate license. I'm gonna introduce Tyler here.
Hi guys, good evening. My name is Tyler Dagler. I'm a partner here with Evan at Marshall Reddick Real Estate. And I'm going to be going over the Orange County real estate market with you guys this evening. So just a little background on me before we give it back to Evan. I've sold about 20 million in volume, just over now. I own real estate here in Orange County. I got my bachelor degree in financial analytics at Clarkson, and I just finished the negotiation mastery program at Harvard. I am a total real estate nerd, and I can't wait to go over a bunch of numbers with you guys as we dive in this evening. I'm also a licensed realtor here in California. And yeah, we'll talk to you guys soon. I'm going to hand it back to Evan. Thank you, Evan.
All right, thanks, Tyler. So our team, Marshall Reddick, this is our team here, full of property managers, agents, advisors. We can assist in all your guys' needs, and we have a professional staff that's literally been operating for 42 years now, and we're happy to help. With Marshall Reddick Events, we are ecstatic to show these numbers. We did a total of 49 total events and webinars. We've had over 130 plus RSVPs to our webinars. We're super excited to kick off this year because not only is this the first webinar, but we are so excited to bring back in-person webinars talking about all different real estate topics with investing, buying, selling, lending, and we're actually got a special guest tonight. I'll have Reed Hazard on as well, talking about conventional lending. We'll hear a little bit more about him later, but we're excited to kind of dive into this. So we are going to kick it off. So our annual sales by office, I think this is important to note. Last year we did a total of, or I'm sorry, 2020, we did just under 400 transactions in all of our offices. So again, for those that are unfamiliar where we are, we have a headquarters here in Orange County. We're in Los Angeles as well, but we are in Texas, so San Antonio and Austin, Cape Coral, and Nashville, and our Clarksville office as well. So for 2021, we finished the year off just shy of 850 in total transactions and closings. So with buyer representation and seller representation, and we kind of ended the year off just shy of almost 300,000 or 300 million in sales volume. So we are more than qualified to help you guys either buy or sell, or if you guys have any investment property needs, we are we should be your guys' go-to. And that leads me to the next point is knowing who you're working with. So this is our staff here at Marshall Reddick in our Los Angeles and Orange County office. You see Tyler there, number one. We got tons of reviews, so feel free if you guys want to do further due diligence on us. We got tons of reviews. We got 42 plus years of experience. And why is this important with who you work with? Right, I'm sure you guys are asking that, right? And it's important to have a team who can help assist in all transaction types and areas. The truth of the matter, we've all been around the block. We've had great experience. We've had the bad, the ugly, and more importantly, we can help guide you so that you guys don't have a terrible experience when you guys are looking to buy your first home or maybe buy an investment property. So I think it's important to note that we've had that experience. We can guide you in the right direction, and you guys are going to be in just great hands.
All right, guys. Hello, it is Tyler again. Let's talk about Orange County real estate and what we're looking at in 2022, what that means for you guys being buyers. Evan will be chiming back in later to address sellers. And yeah, what we can do to help you guys win. So here's just a little overview of recent sales for us, almost 800 here. And basically what we're just trying to show is that we've closed transactions in literally every major metro here and most outlying cities. All these areas had different rules, different regulations, different negotiation tactics do or do not work in these different areas. They're all their own living, breathing environments, and having experience in each and every one of those is a competitive advantage for you guys. So we just wanted to highlight that real quick. All right, Orange County, California. So this information right here, we have a little bit more updated on the next slide, but basically as of 3 weeks ago, our median home price here is 1.1 million, and the homes have appreciated approximately 20% year over year. And looking at property classes, this is a way that we can divulge based on location, on amenities, on price, where a home lies compared to the standard in an area, right? So looking at this, we can see that between A and B, about $900,000. That's what we consider an A-class property here in California. Pretty crazy to think, you know, going into other areas of the country where $450,000 could be the highest price point in their county. That's considered our D. And this is how we rate properties for investment. And there's an entire booklet diving into this. If you guys are super nerdy into numbers and finances, I can send this over to you. More than happy to do it. But just to kind of give a basis as we move forward here, 900,000 is what we're gauging to be about an A-class property at this time. Okay, my favorite part, the numbers. Okay, so this is as of 12/23. This is the market that we're looking at here, okay? So looking at all attached homes, this is going to be your condos, your townhouses, apartment styles, duplexes, things of this nature. Okay, the median price point as of just a few weeks ago is 575,000. Looking at the market, we can see that currently there's only 396 of these active. Now, to give that some perspective, we have 3.1 million citizens in Orange County with under 400 detached homes available at the moment. But if you look at the demand in the last 30 days, this is the number of homes that have been put into escrow. We're creeping up on 650. So it shows that the inventory is there. It's just being gobbled up with these low interest rates. Looking at the market time, 19 days. So from the time that we put a sign in the front lawn to the time where we're entering into escrow is about 19 days here in Orange County. Now you compare that to a year ago, 40 days. So homes are selling twice as fast. Compare that to 2 years ago, 73. We're coming up on quadrupling. So the speed at which these homes are hitting and selling and getting under contract and no longer being available to you is decreasing at a rapid rate. And there's a special reason that I bring that up that we'll get to here. And the same thing we're seeing in detached homes, single family homes, right? Currently there's 676 active. Again, 3 weeks ago, right? So that has changed a little bit. In a county of 3.1 million people. The median active price for active listed homes from all of Orange County is currently $2 million. And you can see in actives, Pretty wild, but there are more homes, detached homes, listed at over 4 million than there are at 1 million or at 2 million, right? That's not necessarily to say that this market is one in which the homes are extremely expensive and out of reach, more that the lower price point homes have been getting gobbled up. And this is just kind of Orange County all together, right? So current actives, again, oh, sorry, let me skip past that. Okay, sorry, I went in the wrong direction. And again, here are our values. We're up about 21% year over year in appreciation. The forecast for next year shows another 8 to 10% in appreciation. So a couple other numbers that I want you guys to be cognizant of. So forecasting for 2022, the forecast is there to be approximately 4% less closed sales than there was in 2021. That amounts to about 2,000 less homes they believe will come on the market this year. The way that the market is looking so far, our opening to 2022 has been the lowest that we've had in a very long time. In the next 3 to 4 weeks, coming up into the first week of February, this is when most homes traditionally start to hit. These are all the people that have been remodeling over the winter, who took the winter off. This is technically and statistically our best home crop of the year, because again, people have been planning, putting time into it, and they all kind of hit here in the spring. It's our hottest market. Things will then die down a little bit. Coming into summer, we'll come back up. We're set to peak at about 5,000 homes available for sale in August, which again is about 2,000 less than last year. Last August, we had about 7,000 available. So we'll hit about 5,000 in August, and then that will start to creep and pitter into the remainder of the year. So what we're looking at is appreciation of 10%, call it 8 to 10%, with 6% less homes being sold. Right, and that's why we're getting this appreciation. Interest rates are low. There's not a lot of inventory, so the values are going up. So we're going to talk a little bit about what buying a home with us looks like, and then I want to show you guys something to kind of emphasize the points that I've been giving you this evening. I know you guys believe what I'm telling you, but just for a little bit of proof, right? So buying a home, right? These first 6 to 7 points are pretty standard in any good real estate office, right? We're going to discuss what your requirements are. What kind of style home do you like? You know, what location? What are your price points? We're going to look at specific facts and financial alternatives to make sure that you're getting the best deal you can. We're going to provide you information on all the homes available, right? We're going to provide you access to the MLS so that you can get in there, scroll through yourself, and take the wheel on the shopping experience when you so choose. And we're going to show you around those areas. We'll show you the schools. We'll get you area vibe reports. We'll get you into the home so that you can actually, you know, touch, taste, and feel. But the value differentiator in why you want to hire us in 2022 is because we've been having extreme success actually finding homes for you to buy. Earlier, I talked about how we're seeing dwindling inventory. If any of you have been shopping for a home at all in the past 90 days, then you know the story. Very little MLS inventory being sent to you. 60 showings in the first 24 hours, 18 offers in the first 48, right? It's a competitive market. And that strategy of waiting for an agent to send you a home on the MLS, going to that open house, submitting an offer amongst 50, 60 other people, and then, you know, giving up on a lot of your negotiations just to try to get the win is a strategy that's not as effective, we're finding, for our clients and versus what we are doing, which is actually going and finding the homes off market. A little slogan we've been saying here in the office is that the off market is the new MLS. And that's totally true. And I want to display to you what I mean. So I'm going to attempt to not mess this up here. I'm going to scroll in. Let's make sure I'm still logged in. I am. These are, just so you guys can see and being transparent, these are all the sales in Orange County in the last 90 days. And let's do the last 30 days, if we will, just to make it even tighter. Right? Scroll here. This field right here is days on market. Look at all of these homes, page after page after page after page after page, 0 days on market. The reason for this is that these are deals that are being done off markets, and then the agents are coming in and logging their sales so that they can add one to their scorecard, and you know what I mean? So they can bump up, their historical numbers, their total volume, things of that nature. But these homes are not hitting the market. You guys are never getting the opportunity to even see these, right? And this is what me and Evan are doing for our clients, is we're identifying specifically where you want to live, what price points you need, what kind of home you want, so on and so forth. We get with our connections, if you will, and we pull up the information of all those owners and we call every single one. And we'll go knock on all of their doors and we bring them all the documentation in their hand to show, hey guys, I know that there's a percentage of you that want to sell. You just don't know what to do, and or it's a global pandemic. You don't want 100 people through your house in the next 24 hours and all the everything that comes with that. We help them sell to you. And we found extreme success with this over the last couple months, and we really see this being as the way forward to success in 2022. And I'm sure there's a lot of people out there who say that they'll do that for you, but we actually will. Coming into here, I'm going to hand this over to Reed. Guys, if anyone has any questions, please feel free to let us know. I appreciate your time this evening, and I look forward to talking with you all very soon. Thank you guys so much, and Happy New Year's.
Awesome. Great job, Tyler and Evan. And excited to be here with you guys tonight. My name is Reed Hazard. I'm the lender for Marshall Reddick. Have been since 2005. And since we're talking about Orange County tonight, obviously it's really close to home. I'm in Orange County. I live in San Clemente, California. I'm about 20 minutes south of the Marshall Reddick corporate office out of Newport. So super fun to talk about our own county tonight and to see some of those statistics. I really do have to agree to really getting down and dirty, if you will, and going out and door knocking certain communities and doing what Tyler's talking about. Those are the agents that are experiencing really a lot of success for their clients, and also you're seeing it in their numbers because there is just so little inventory actually hitting the market right now. So I definitely believe that for 2022, that is going to be a big part of people finding, the property that they want and getting a good deal. And also, like I said, finding a property that they want. There's just not a lot of inventory on the market. So jumping in to conventional, a little bit about myself. So again, been doing this since 2005. Bought my first property through Marshall Reddick when I was 19. I'm nationally ranked each year for loan volume in the top 100 loan officers nationwide. And then me and my partner, Al Rodriguez, so we run the top mortgage team for loan volume and for individual originations in all of Orange County. Since 2017, we've been the number one volume for Orange County and for Orange County sales. Last year, we did $361 million in loan amount with an average of about 20% down. So you could figure we probably did about, close to 500 million in total volume production, but 361 million in loan volume last year. And in Orange County, we did about 200 million in just purchase. So my name and my partner, Al Rodriguez, and our team name, which is the Rodriguez Hazard Team, you can Google that name. We've got many 5-star reviews on Yelp and on Facebook and all the online places that you can get real estate reviews done. So definitely look us up. What brings the value here for my approval letter, especially in Orange County, is we just work with so many of the other top teams within Orange County as well. Marshall Reddick really being my flagship. But again, just when other agents see our approval letter, they know you've been approved by me or by Al and by our team. They know that we've pre-underwritten the loan. They know we have an amazing track record and really that we specialize in purchase loans. So it's definitely a team sport. Interest rates, you have to have among the lowest rates. I learned that a very long time ago, and I priced my rates phenomenally. And next to that, it's about service. So pricing and service go hand in hand. And then obviously the execution and knowing who you're working with. Most of these listing agents and sellers agents right now, the first thing they do when they get 3 offers or 10 offers, or maybe it's only 1 offer, they're looking at the who is the lender. They're contacting us. They're asking questions. Obviously, our obligation is always to you not to divulge too much information, but we want to make you look good, right? We say they've been fully pre-approved. W-2 client. They have amazing credit, all the reserves, all the assets are all verified. And then we just point to our track record. So there's a good chance that if we're writing a deal on the market and there's another agent involved on the other end, that when Evan or Ross submit these offers, and Tyler submits them, those other agents know who we are. They know that you're approved to the right lender, and that goes a very, very long way. So that's part of the value that we bring locally, and really how we operate within the Orange County market to help bring more value to you guys, and not just getting you guys alone, but really this being a team sport and working together to make this work. So another thing that I want to mention is that I do a lot of out-of-state financing for Marshall Reddick, and we're licensed all over the nation. My company's in all 50 states. We're the 10th largest bank in the nation too. So we're like a Bank of America, but with really, really fast service and my own dedicated team. We're licensed everywhere, and then I'm personally licensed to lend in all the states on this screen. So Marshall Reddick, we don't just help you buy your primary residence. We really help you invest in real estate as well. So any of you that don't own property out of state or that might want to invest, where maybe the numbers make a little bit more sense for you if you don't have as much money for down payment to get into the local market here in Orange County, there's amazing opportunities through Marshall Reddick in Texas and Tennessee and Florida. And Evan and Tyler can point you in that direction if you're interested in that. So again, getting you pre-approved to find out what you qualify for, and then really specializing in primary residence and investment property financing. So I want to walk you through some of this a little bit faster tonight. I don't want to go into too much other than really what's on the screen on some of these slides so I can be mindful of everybody's time. But what are the 5 steps of getting pre-approved? First off, what is getting pre-approved? So it's submitting your financial documents, getting a credit report ran, so we know what your mortgage scores are, not what the scores are on your online credit card account or what you get off Credit Karma. This is what your actual scores are going to be when you run your credit to buy a mortgage, right? To get financing. The scores are usually a little different when we run them. So we want to run that. We want to run the loan through an automated underwriting system with Fannie Mae or Freddie Mac, wherever we're going to sell the loan to. Most banks and loan officers do not do the AUS, the automated underwriting system, at the pre-approval stage. They do it later on in the process after you're in contract, and that's not something you want to do. Doing the AUS gives you a loan number. It pre-underwrites the file. It allows us to make sure that we're really dotting all our I's, crossing all our T's, and this is the insurance for us, for you, for the realtor, that we're shopping in the right price range. We're not going to have any hiccups or any surprises. So running that AUS is very important. Again, getting your documents, your W-2s, pay stubs. For a primary residence loan, a lot of times we don't need tax returns. We can qualify you off just your W-2s. It's a much it's a much easier loan to qualify for from a documentation standpoint for most people that are W-2. If you're self-employed, we've got to get your tax returns, and it's a little bit more intricate. You'll need P&Ls and year-to-date balance sheet and things like that. Any lender will require that. But again, part of getting you guys approved, getting you guys prepared, giving you an accurate overview of what you qualify for, and then what payments are you comfortable with? Okay, well, what does that sales price and loan amount look like based on your down payment, so that we get you a monthly payment that you're going to be married to, right? And then again, is that going to be able to get you to what you want to buy? So this is all part of that discovery phase, getting you approved the right way. Then I give that information to your realtor, and they're going to dig into it with you. Tyler's going to go through all of that with you guys, very, very in depth. And then we're going to know what our price point is going to be to really start getting aggressive. When you get pre-approved, we can write an offer to close in 18 days. I can close a deal in 18 days in Orange County from start to finish. Okay, that allows you to be as good as all cash. But again, if you just run your credit and do an application and don't want to send any documents, it's only harming you being in this market trying to shop aggressively. Lenders like me, we're far and few between where we put this much money into the front of the transaction like I do. And I do that because I want us to be able to write a really aggressive offer. I want you guys to know your numbers, be ready for that property, and then, man, we find the right one, same day that offer's going in. And if it's off market, same type of deal. The sellers a lot of times want to close quick. They really want to know you have an amazing buyer. People that are serious are the ones that are going to get those deals. So after we go through this process, I also have an underwriter that pre-approves the loans. I don't. My underwriter is Mike Lynch. He's been underwriting loans for 30 years. He underwrites all of my loans up front for accuracy. Again, this is my insurance too, so we have no blow-ups later, and so the terms don't change, and you guys know your terms up front. So after we get you guys pre-approved, again, you do it usually through my website. I send all the next steps, all the instructions after we have a consultation call. And getting you guys approved takes about 24 hours from the date we get the application and documents. We'll then send a generic letter of approval similar to this. We'll send it out to all parties. Then I always schedule a call with you guys, especially if you're first-time buyers. I'll schedule a call to go over the closing cost worksheet. We're going to go over line by line. What are title fees? What's an escrow company? Why are they involved? What is the fees going to look like for that? How often are property taxes due? In California, what's Prop 13? How do my taxes go up and down over time, and by what percentage? Really educational stuff that I feel like loan officers don't spend time doing with their clients, and that I feel like this is how I became successful in the industry, was through education and spending my time. Again, my interest rates are phenomenal. I'm like the biggest bank out there. So I make sure you know how good my rates are. We get past that, and then we really commit to each other. And especially on the first-time home buyer, we're really going to go that extra mile and talk through everything. People that have bought quite a few homes or selling to rebuy, they want the same service, but a lot of times they don't want to go over so much info they already know. And so it's, I'll kind of gauge the relationship a little differently depending on your experience. But for a first-time buyer, especially any of you guys on the call, educating you is very, very important. It's going to allow you to make faster decisions when you need to get the right deal in this type of market right now. So again, we get you guys approved, get the approval letter and the details over to the realtor, Lou and Tyler and Evan so that they know, and then you guys start shopping. Now, just to teach you a little more on how we're qualifying you for these loans. People keep getting a little bit worried about the real estate market, and they're constantly asking me, well, God, it just keeps going up and up and up. The difference between now and the last time that it had gone up so much and then dropped a lot in 2006 is when we kind of peaked, in my opinion, 2007, and then it really went down in 08, 09. It was because anybody could get a loan without verifying this slide, your debt to income ratio. You could say you make $15,000 a month bagging groceries at Albertsons, and your loan would get approved because they weren't verifying pay stubs. They weren't verifying any of your income documents at all. And they were looking at credit. And even if you had bad credit, there was a loan product to put you in. Probably had a terrible rate, but there was a way to do it. And so when the jobs market started really hitting just a wall, and real estate values couldn't go up anymore, and obviously everybody knows what happened during the loan crisis, there's nowhere else to sell that debt to, and it all fell apart. When that happened, the government had to come in and buy Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac are the ones that are giving money, or rather buying loans from banks like ourselves and BofA Wells and all the smaller lenders and direct lenders that are getting really low rates. If you're getting a really low interest rate on a 30-year loan, it's most of the time it's being sold to Fannie Mae or Freddie Mac. Fannie Mae and Freddie Mac got bought out by the government through that last collapse that we had, and they changed their lending guidelines entirely. And so over the years, you've had to qualify with specific debt to income ratios. You've had to have a certain amount of reserves, a certain FICO score. And the down payment requirements for a long time still required 20% down. All the way from 2009 to about 2012, there was nothing but 20% down. And over time, you were allowed to do 5% down again. But that wasn't until jobs had really come back at around 2015 that you saw 5% down even being used a lot. But it was always based on these principles, debt to income ratio. So the max debt to income ratio for buying a primary residence with a conventional Fannie Mae loan, remember the lowest rate, lowest down payment type loans, is about 49% of your income. So how do you calculate your debt to income ratio? Let's say you made $10,000 a month in gross income. You're W-2'd, but not after tax what you're making. Your gross income is $10,000 a month. Let's say the monthly payment for the home you're buying with principal and interest on your loan, property taxes, homeowner's insurance. Let's say there's even an HOA in there. whatever the fixed expenses are, not utilities or any of that, but the fixed expenses. Let's say that payment's $4,000 a month. $4,000 divided into $10,000 a month of income would be 40%. You'd have a 40% debt to income ratio. Then we add on any minimum payments on credit cards, auto loans, right? Anything that's on your personal credit that's not tied to a business, even if it's on your personal credit, but it's tied to your business, we can show that and we can omit that. But anything that's on your personal credit, let's say those total debts are $4,500. Well, $4,500 divided into 10,000, you'd have a 45% debt to income ratio. The max debt to income ratio based on your credit scores is sitting in front of you right now on the slide. Now in Orange County, you can take that max conventional loan amount pretty high, and I'm going to cover that in just a minute. You can do a minimum of 5% down in Orange County, really 3%, but 5% to be able to get into a higher price range. There's a lot of people that are just out of school a couple years, already making $175,000 a year working at a law firm, or, have started a business when they were really young and they're making great money. They saved a lot of money. Or maybe they're making amazing money but don't have a lot of savings quite yet, but they can easily afford the payment and they need a tax deduction. They can write off $750,000 a month, a year in loan against their income. So they need to get a tax deduction. They want to have pride of ownership. There's so many reasons why they might want to buy, but if they don't have a 20% down payment, you can buy to a pretty high price point using this type of financing. And it's conventional financing with 5% down. But as the government has raised the amount that they will lend, why this is way different than last time is you have huge demand for real estate. You have a very strong jobs market, especially people that can afford these properties. And the government has never changed these guidelines. They keep raising the loan amount that they'll lend, but they're not going, okay, now we're going to allow you to buy at a 30 or at a 65% debt to income ratio. Nothing like that's happening. If anything, they're starting to make it even more conservative again. There's a couple of things that just happened today that I'll cover a little bit later. They're making it a little bit more conservative to qualify, which I like to see. But just because they're lending more does not mean that the market is in some crazy bubble, especially not here in Orange County where there's so much demand. They're making sure that you guys qualify and can afford to pay for these types of properties with verified income. So as you see here, even though with a 640 to 660 credit score, you can go to about a 50% debt to income ratio. When you're going with minimum down payment less than 20% down, we always advise different types of loan product based on credit score. So if you're a 700 plus, even with 5% down, a conventional Fannie Mae loan is best. If you're a 680 and below and you want to go with minimum down payment, you'll probably look better on an FHA loan. These are things that we'll cover though when we get you guys approved. And FHA and conventional loans now go to almost $1 million with only 5% down. So I'm going to show you that here, I think on the next slide. Yeah, here it is. So Fannie Mae had their loan limit set at $417,000 from around 2004 all the way to 2015. Obviously, we had the market crash in 2008, and from that point, the government didn't change anything. They just kept that loan amount of $417,000. Fannie Mae and Freddie Mac were taken over by the government. They made their guidelines more restrictive. They completely changed the lending industry with what's called the Frank Dodd Financial Reform Bill. Any of you that want to look into that to really just learn more about what I'm talking about, it will give you more confidence in our real estate market because Fannie Mae and Freddie Mac buy almost all of this debt that's being printed for these types of loans, which supports literally 90% of our entire housing market nationwide. Okay, but Fannie Mae and Freddie Mac, they've kept raising that loan limit. Ever since around 2015, they started to see about, 1 to 1.5% wage inflation growth. Annually, that rose to around 2% right before Trump was elected. Then the tax reform went through. You saw that go to over 3%, highest year-over-year wage inflation that we'd seen in decades. And that's what caused, the Fed to raise their rates a little bit in 2018. We saw them then come down in 2019. But through all of that, they kept raising their loan limit. and they went from 417 to 424,000 in 2016. Then they went up again to like 438. They've raised that every year. Last year, it was all the way nationally from 417 to all the way it had gone to 547,000. Well, this year, because of the growth we saw over the last 12 months, and because of the wage inflation growth that we're seeing, and because of the potential growth we might see in inflation over the next 12 months with wages, because there's so many unfilled jobs, there's 11 million unfilled skilled labor jobs right now. That's called the JOLTS report. That's the Job Openings and Labor Turnover Survey. You could look up the JOLTS report and see what types of jobs are available out there for skilled workers, people that can afford to buy homes, and how many are there. Before COVID, there was about 7 million. That was the highest reading of all time. Right now, and because our population keeps on growing, even though jobs were tightening, had a lot of jobs available actually. Now we're at 11 million. Some of those jobs may never come back. Most of them are jobs that people still need to get and that are out there in growing industries. So that goes to show there's a lot of room for the jobs market to keep moving into. And people historically are not wanting to sell their homes. They're comfortable where they're at. And because of that, we have low inventory, and we have people that just got really, really low rates the last few years, really the last 10 years, but really low the last 2 years. They don't want to sell. They don't want to move. This all is going to add to the tightening of our markets until for some reason everyone starts selling again. It's not being seen why people would really do that right now with the trends that we're seeing. But again, at least the government is being accommodative with what they will lend, not making it easier to lend, or rather to qualify, but raising the amount that they will lend. This last year for 2022, they just raised it for 2022 from $548 to $647,000 is the national conforming loan limit now that Fannie Mae will lend. Why is that important to you? That means with 5% down, you can go to a $647,200 loan amount nationally. That means you can get a really, really low interest rate with an affordable payment going to that high-end loan amount. That helps to support the market. FHA did the exact same thing in most markets. They're not quite as high in all markets, but to accommodate for more wage inflation, and for a growing real estate market due to low inventory. You also, now you look over on the right-hand side, this pertains to Orange County. They raised the loan amount from $822. That was the max you could go to last year for 2020 or 2021. You could do 5% down to an $822,000 loan amount. This is why these homes right here and that lower price point, especially, they're getting gobbled up quick, and you need the best representation right now. Great example, in Orange County, you can go now 5% down to a $970,000 loan amount, okay, for a one-unit property on a conventional loan. They raised it by about 20%. That's as much as real estate went up in the past 12 months. Why would the government raise this loan amount by 20% if they thought that the market was going to fall on its face? They don't believe that. They really don't, or they wouldn't have increased what they will lend. So this is very, very powerful. Now, if you want to buy a duplex or a triplex, I own a duplex in Eastside Costa Mesa, best investment that I ever had. I know that Evan on the call, he recently bought a triplex up there. He's living in one of the units. Now with the government raising these loan limits, last year the loan limit was $1,053,000 for a 2-unit. This year they'll go to $1.243 million. Now, 2-unit primary residence requires 15% down. 1-unit primary residence requires 5% down. So that $970 loan amount, though, you can buy over $1 million sales price now with 5% down. Just unbelievable. 2-unit, $1.243 million. A 3-unit now, you can go to 1.5. In a 4-unit, you can almost touch a $2 million loan amount. Now, 3 and 4 unit buying as a primary residence require 20% down. 2-unit requires 15% down as a primary residence, and 1-unit requires 5%. On an FHA loan, you can go 3.5% down, all the way to a $1.243 million loan amount. So I'll dig more into that on a conversation on a follow-up call to give you guys kind of the differences in the loans. But again, know that on 1 and 2 unit, FHA allows 3.5% down. And all of these products require at least 20% down on a 3 or a 4 unit. But again, this will help you if you're trying to get into the Orange County market and you maybe want to buy a multi-unit and live in one of the units. Last year, the loan amounts were still pretty high, but I mean, the bump that they just gave us, it will get you into this market now. Whereas last year, it was a little bit of a struggle. You're having to really still put a lot of money down in most cases to get into that lower $1 million mark on a primary residence 1 unit, or to get into that 1.5 or 1.6 mark as a 2 or 3 unit. It was a bigger stretch, and right now it just isn't because they raised the loan limits. And just real quick, so again, I had mentioned that at Marshall Reddick, we really specialize in helping you build a portfolio of property over time. That could be 2 or 3 properties where you want to have, a few extra 401ks when you retire, basically working for you, or that could be a portfolio of 10 or even more than that. I offer the financing through CMG Financial to get up to 10 finance properties. After 10, the loan is no longer Fannie Mae or Freddie Mac or conventional. It'll be a non-conventional loan. And Patrick Prunty at Marshall Reddick offers the best private financing out there. It's through Marshall Reddick Borrow, and it's phenomenal. And usually that's good for buying out of maybe a self-directed IRA account, or if you can't qualify for conventional financing, it's the next best thing. But at Marshall Reddick, again, we're big on helping you build a portfolio of rental property, eat, sleep, and breathe real estate. And this financing I'm talking about is available to 10 finance properties. When you buy an investment property, the minimum down payment is not 5%, it's 20% down. And we really advocate 25 or 30% down so that you have a little bit lower leverage on the property. The interest rate is a lot better with 25% down versus 20 when you're buying an investment property. They just tend to debt service better with 25% down. And again, though, you can buy as little as 20% down. I will say rents have gone up in Orange County as much as property. Tyler just rented out with Marshall Reddick. He just rented out my old property in San Clemente, my old primary residence. 2-bedroom, 1 bath for $49.95. Nice single family home, beautiful home, but very small. It's 986 square feet, and it rented for about $5,000 a month. And that was the market rents. And a year ago, I probably would have gotten $3,600. 2 years ago, probably $32. Even though the home is worth well over $1 million, the rent to price ratio in Orange County and California in general has been very low. It just tends to always be very low. And you've seen that. You've seen rents go up a lot. So you may be able to move out of your home right now, rent it out, buy your next property, and now you're really building your wealth here. You may already have done that 1 or 2 times, and now you're going to do it again. But it's a phenomenal time to do that because just because prices are higher, again, rents have gone up dramatically, and that has changed the entire landscape on how an A-class property looks and performs. So yeah, just awesome stuff. I'm so excited right now about real estate. Never have been so excited by it. Another thing, you guys here, the financing gets a little harder to get after you have 7 homes. So once you get to 7 finance properties, you're required to put a little bit more money down, and you're required to always have a 720 mid-credit score or higher when you buy. But the interest rates are no different. All the way from 1 to 10, the interest rate is going to be based on your credit score and your down payment. All right, so yeah, just real quick to anybody that mentions this webinar, and we meet this way through Marshall Reddick, we will pay your appraisal up front if we close on a local deal together. For out-of-state loans, they just tend to be a lot smaller. We have very little margin in our rates, so we can be as competitive as possible. But obviously on local transactions, we're able to pay for your appraisal fee up front if you mention this webinar. And obviously know who you guys are working with. We have hundreds of 5-star reviews. All these are verified reviews. We really know how important that service is. This is why Marshall Reddick has really always been my flagship. It's really about the client here, you guys. I mean, we see the long-term benefit in providing great service and in repeat business and getting your guys' referrals, and we greatly appreciate them. So this is going to leave me for the end of the night. I'm going to turn it back on over to Tyler and Evan. Just real quick, I do just want to mention, though, there's a lot of jargon online and on CNBC and everywhere right now about interest rates going up. Yes, they're going up. We need to see what the inflation data for December looks like. We need to see how the supply chain issues work themselves out over the next few months. There's a lot to analyze with the Fed and what they're going to do over the next quarter. But as long as inflation slows down a little bit, the one thing they don't want to do is raise rates too fast or shock the heck out of the market. Just rates going up 0.25% this last week is enough to slow things down more than people see or understand, because you go online and there's just so much stuff everywhere, and then you start getting all these mailers to refinance, and a lot of it is for marketing. Yes, they're going up. They'll go up to a point, they'll slow down, then they'll come back down again. I've been watching this for many, many years and studying it in detail. I have other webinars I've done on the Marshall Reddick website underneath the Learn tab. I did one specifically right after COVID and literally called this entire market, what markets to buy in, with the help of my partners in Marshall Reddick and with our analysis on the market. Go and watch that webinar, see who you guys are working with. Again, just know that those rates, they'll go up, then they'll probably come back down again a little bit. And it's going to be really a monthly review of what's happening. There'll be a market update going out for me. It goes out every Saturday. If you guys want to be added on it, just send us an email and we'll have you added on right away. So I'm going to start doing a monthly, really in-depth market update for all the Marshall Reddick staff and for all the Marshall Reddick clients. So you guys will be getting something in your inbox. I'm going to really track this next 12 months for everyone and try to really predict in a way what's going to happen through the data that we're seeing. And again, a good time to start looking at buying a house while the rates are still lower than they ever were before COVID. That's where they're at right now. But it's very likely we'll see them drift back to the mid or maybe even the higher threes over the next 12 months. So again, just some information for you guys. A very good time to look at doing this if you are very rate sensitive. Thanks guys for letting me speak. Tyler and Evan, I'll push it back over to you.
Reed, thank you so much. You definitely gave a tremendous amount of knowledge, and I think you can chime in on this part too. I mean, if for those that are on the fence with buying, rates are going to go up this year. So if you think you're approved for $1 million and rates go up, 0.5% or even 1%, well, now you're now approved to, let's say, that $1 million home. Now it's, let's say, 800, right? So for those that are on the fence, just give Reed a call. He will guide you in the right direction, and you guys will truly be in great hands. So Reed, thank you so much. Appreciate it, buddy.
Thanks, Evan.
All right, so those next part of the segment, those that are getting ready to sell, we kind of created a little checklist, little items for you guys, and for those that are more serious about it, we can email it to you or just have a one-on-one conversation. But for example, if you're gearing up to sell this year, let's definitely chat. Let's definitely talk about your goals and discuss what that looks like for you. More importantly, Tyler and I would like to at least check out the house, give you some recommendations. But we always suggest, let's declutter the house. Less is more. The photos show better in the marketing material. Maybe some fresh paint. Let's spruce up the landscape. And then let's discuss any repair items that need to be fixed so that it's not being drawn upon to the buyer. Right, we don't want to blow up the deal and the buyer gets freaked out because there was once a plumbing issue and you could see the repair item in the roof or whatever, or the ceiling, right? So let's definitely discuss your goals if you guys are getting ready to sell. We would love to have that at least one-on-one conversation and carry it out for you guys. So how do we determine home value? Again, for those that are really interested in kind of learning about that, obviously there's sites such as Zillow and Redfin, and they kind of spit off a generic value, and we kind of tend to laugh at those values at some point because they're not really accurate. They kind of are more or less like a 10% buffer, could be higher, could be less. But we really try to analyze the goal. We want to look at the market data on what that area is forecasting. So for instance, in this scenario, this was actually a deal that we actually found off market, triplex for a buyer of Marshall Reddick. And we sat down with him and kind of looked over the comps and everything like that. So obviously, going down the list, there's active. So we want to compare the bedroom count, the square footage. With multifamily properties, it's a little bit different compared to your traditional primary. A lot of the fact with multifamily is we're looking at income, and then we're looking at unit mixes and things of that nature. But majority of fact is we're looking at square footage, right? So we'll base it off of a price per square foot. So going down the list, you have the closed. So this property is showing that I'm talking about the red line here. It's showing that it's just over 1,500 square feet. So we pull the comps that are at least half a mile, maybe a mile or two nearby, and really hone in on what features that are similar to the ones that just sold. So for this property, we took an average. It's probably just right around $1,680,000, give or take, and that's kind of what the sales price, what we're in escrow in. So again, if you guys are truly curious about your home's value, we're more than happy to give you guys just a valuation report, free of course. And we just want to make sure you guys are set up for the great success. So moving on, we provided some 3 tips for sellers. One, obviously deep clean and declutter is definitely number 1. So you may have a ton of pictures on the wall or just personal things that maybe you don't want everyone and all the neighbors seeing, your personal items. So we recommend just put those away. Let's box those up, and let's deep clean and declutter your home. Number 2, only look at current information to determine the value of your home, right? So what we mean by that is there's so many third parties that say they have the magic wand or the magic tip of your home's value is this, right? So we want to compare apples to apples, not apples to oranges, right? So if you guys are truly interested in your home's value, Tyler and I are more than happy to discuss that with you. And then number 3, be realistic with your list price and time frame, right? If you tell us that you guys have 90 days to sell, maybe we'll price a little bit more aggressively because we have that time. But if you guys maybe are saying, hey, we need to be in Arizona in the next 2 weeks, we're going to price it really, really realistic, right? So those are our 3 tips that we guys try to tell you guys so that you guys are more aware of the tips for sellers. Now, another question we get all the time too is, should we renovate, update, or just sell as is? If you have the funds to renovate, we always encourage to do so, right? And it's important to get us involved the first step, due to the fact we don't want you to spend just your money on pointless things that it's not really going to have a dramatic effect towards the buyer, right? So first off, call us. We're more than happy to walk the property, suggest certain items. Maybe, hey, let's spend the money on countertops that will show great in the photos, and ultimately it will increase your value of the home. Or maybe a fresh paint on the exterior, or paint on the interior, or bathrooms, or things of that nature. So the market is always in favor of renovating. I always have a kind of coined a term that people pay for perfect. So if the more that you can do, and if you have the funds to do so, absolutely do so. It will ultimately net you more in the long run than selling it as is if you have a home that was maybe built in the 80s or so. If you have a home that's hasn't been touched since the 80s, we really recommend that you guys remodel it. Otherwise, you more than likely will either sell to an investor that is going to buy it to flip it. So if you guys are having any consultations, give us a call. We're always happy to discuss those with you. Now, our marketing plan for our properties, different compared to most. I mean, we do most of the main things that every agent does, right? We'll post it on the MLS to get exposure. We'll put a lockbox on there for easy showing access. I typically like to be at all showings I like to be present there. I want to really sell the home. I want to understand what the buyer's needs are. And, you know, if your home has a funny floor plan, you know, I like to discuss them like, hey, if we move this wall, this will open it up, this will be the price, and just ultimately try to really, really sell your guys' house. We like to get professional photography. I think that really showcased the home, and we like to do a twilight photo. It adds more effect to the home, and of course, looking at it in the buyer's eyes. I mean, a lot of buyers spend countless nights looking at homes online, whether it's through Zillow or Redfin, searching through, looking probably at the photos to see, oh, is this a cool house, or is it taken by an iPhone? And you can tell in the photo, right? So that's some of our marketing plan that we like to do. I think the biggest thing is I like to do a pricing strategy. And again, this is going back to your guys' goals. Is I typically like to list the properties slightly under value, and it's not a price that we're going to sell at, right? It's ultimately a goal just to get people through the door. The more people that we can get through the door at the same time, it's going to create a bidding frenzy, right? So we're going to get as much people packed through that door to show like, oh, this is a hot home right now. We need to act quickly. And that is the whole reason for that. So I have a couple examples that I've done that, and it's been a major success. We've listed properties, say at $1 million, and that's not the price that we sell at, but we typically will sell a property that way, maybe 15% higher or even 20% higher. So it's just again, it's the different marketing strategy to do that. And it's not a bait and switch. It's mainly just to get a bidding war. So yeah, moving on. Again, our marketing plan, you know, we like to typically get feedback from agent, and we will show you guys that feedback. We want to be brutally honest with you guys. We want to make sure that we're communicating with you through every step of the way so that you guys are not lost in the dark. It surprises me that agents will get listings and you never hear from them again. And it leaves you with wondering what's going on with my property. So we want to make sure that you guys are in contact on a regular basis. We typically like to do a weekly email or a call, whatever you guys are most comfortable with. I typically like to send out an email saying, here's the amount of showings, here's the amount of feedback, this is the feedback we're getting, and you know, we'll tailor an approach and see if we need to pivot from there. Some of our recent transactions that Tyler and I have done. This is Tyler's recent transaction. Again, as you see, Tyler did a closeout transaction in Temecula, then Lake Forest. We do a bunch of stuff everywhere. I've done some stuff in Corona del Mar, Newport Beach, and yeah. So that's important to note that we will go anywhere, and as long as your goals are realistic and you guys have a timeline, Tyler and I are more than happy to conquer that goal, make it a dream. Moving on, 1031 exchanges. So I won't spend too much time on this. It can get very, very complicated. More or less, we have a great 1031 accommodator that if you guys are in the midst of doing a 1031, maybe you don't want to pay taxes and you want to 1031 into a better or easier property. But it goes on a property qualification. So every real property is held for a trade or business for investment. So you have to exchange like mine to like mine. So if you have a real estate property, you have to trade into a real estate property. So you can't go out and buy a car with it and yada, yada, yada. So there's different 1031 examples that we could show you as well that we've helped clients do so. But a main point and big timeline is we have to hit 45 days to identify a property. So, and you have 180 days to close on that exchange. So that is very, very important to note that you have you have to identify 3 properties in 45 days to not get hit with that big tax burden. You don't have to close on all 3, but you have to at least lock up 3 and give that to the 1031 accommodator so that they make a reference so that you're not getting hit with that 1031 or I'm sorry, the capital gains tax. So where to begin? Obviously, call Tyler and I. We're obviously here to help you guys, and I think a big factor is if you guys are buying, obviously, chat with Reed. Reed is filled with knowledge and can guide you in a good loan product, and kind of tailor an approach that fits your guys' goals. That's where to begin. Call us. We're more than happy to discuss whether you guys are buying or selling. Even if you are selling, I think it's wise to even speak with Reed and kind of figure out your next move from there. That's our recommendation. We're more than happy to kind of determine your must-haves, wants, can't-haves, just evaluate your options. You guys are thinking about selling, we want to go over your goals and discuss maybe it's not wise to sell it. Let's keep this property. You have enough equity here, you make a good income. Let's rent it out. This is your rental values that you can get. You will get this X amount in cash flow, and this will be a great rental property for you. So again, just kind of creating a plan that's more tailored towards your guys' goals. So if you guys are interested in that, we're more than happy to set up a time, maybe one-on-one call, and Tyler and I are happy to do so. So feel free to reach out to us. Next steps for buyers, obviously initial meeting to discuss your guys' goals and timeline is crucial. And of course, again, connecting with Reed, learning your guys' buying power, and again, setting you guys up for a drip campaign. Tyler, you want to add anything here? Anything that you feel is important?
We look forward to speaking with all you guys and digging into your situations and coming up with strategies that we know will and can work for you, and becoming and making friends along the way. We're really excited. It's going to be a great year, and we can't wait to talk to you guys.
Yeah, and again, next step for sellers, chat with us first. We're more than happy to meet you guys at your guys' house, walk through it, discuss a marketing strategy that is perfect for the neighborhood, or if you guys have a house on the water or more inland or whatever the case may be. Every marketing strategy is different for that property. It could be a challenging property, it could be an easy property. So again, preparing for the house for sale and definitely getting professional photography, which we will handle all that for you guys. So and again, lastly, going live on the MLS so it syndicates to all marketing channels and just get enough eyeballs on it so that we can create a bidding war so that you guys will net the most money out of the sale. And again, this is Tyler and I. If you guys have any other questions or want to schedule a consultation with us, please do so down at the bottom here. You have our cell phone numbers there, an email address. Feel free to give us a call. And again, thank you so much for being on our first webinar in 2022 to discussing Orange County, what to know. And Reed, I want to thank you again for hopping on. You expressed a lot of knowledge. It's always new things to hear what's going on in the loan world. So appreciate it, and we appreciate you guys for logging on. Thanks so much.
Have a great night, guys.
Thank you, guys. Thanks, everyone. Happy New Year.
Happy New Year.